Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
After listening to today's news, you'll know first Japan's Nikkei 225 smashes 47,000 record high on new leadership, but the yen plunges against the dollar and euro. So we'll discuss why this stimulus-fueled rally is tanking the yen and what it means for the Bank of Japan's fight for policy independence. Second, Trump administration threatens permanent layoffs in government shutdown, escalating the political battle and risking a shock to consumer confidence. We'll examine how this unprecedented threat of permanent job losses could blindside the Federal Reserve and shake confidence in US economic governance. Third, UK's £1.5 billion housing market overhaul aims for speed, but new binding contract rules could backfire by shrinking supply and raising prices. We'll explore how this well-intentioned reform could create unintended consequences, potentially making UK housing affordability even worse for first-time buyers. Japan's stock market just shattered a historic ceiling. The benchmark Nikkei 225 index exploded 4.75% higher, closing above 47,000 for the very first time. Now, this rally might be more than just a fleeting sugar high. You see, for years, the Tokyo Stock Exchange has been pushing major corporate governance reforms. They've been pressuring companies, many of which were trading for less than their net asset value, to improve capital efficiency and deliver more value to shareholders. The surge, reinforced by the new political direction, might just signal a fundamental re-rating of Japanese assets, attracting long-term foreign capital and possibly marking a true end to Japan's lost decades. The catalyst for this massive rally is a political earthquake. The ruling party named Sanae Takaichi its new leader, positioning the pro-business politician to become Japan's first female prime minister. Investors went on a buying spree, sending shares in real estate, technology, and heavy industry soaring on the news. Takaichi is a champion of higher government spending and lower borrowing costs, a playbook straight out of her mentor Shinzo Abe's Abenomics era. So the thing is, Takaichi's plan, nicknamed Takaichinomics, involves more direct stimulus like refundable tax credits and cash benefits. But here's the problem. Japan's public debt is already the highest in the world, sitting at a staggering 250% of its GDP. The International Monetary Fund has been warning that without a clear plan to get this debt under control, Japan's fiscal stability is at risk, especially as its population ages. This new spending spree could test the very limits of Japan's ability to manage its debt. But that's not the whole picture. While the stock market was celebrating Japan's currency, the yen was in a nosedive. It hit a record low against the euro and plunged 1.7% against the US dollar. Actually, this sharp drop in the yen reflects market fears that Takaichi's stimulus will force the Bank of Japan to keep interest rates extremely low, even as other countries raise theirs. While a weaker yen helps big exporters, it creates a serious problem at home. It drives up the cost of imported goods, from energy to food, directly squeezing the budgets of Japanese households and eating away at any wage gains. This could ultimately increase political pressure on the Bank of Japan to raise rates, which would work directly against the government's stimulus goals. This is where the situation takes a more complex turn. One economist called the market surge a knee-jerk reaction, warning that the very policies designed to stimulate business could further weaken the yen as Japan's national debt grows. Takaichi's explicit call for more spending puts the Bank of Japan in a tough spot. Any perception that the central bank is losing its independence and simply printing money to fund government debt could cause a crisis of confidence, triggering a chaotic sell-off in Japanese government bonds. Takaichi, an admirer of Margaret Thatcher's free market approach, is inheriting a sluggish economy where households are grappling with higher costs and slow wage growth. Now, looking ahead, we need to watch the international stage. Takaichi's agenda will likely involve tough trade negotiations, especially with the United States. To secure a favourable tariff deal, particularly if the Trump administration returns, Japan might have to offer concessions in its crucial auto sector. In exchange, Japan would seek deeper security and technology alignment against China. This could fundamentally reshape global supply chains for critical technologies like semiconductors and electric vehicles, creating new winners and losers among Japan's industrial giants. The market is betting that her aggressive economic plan will spark a new era of corporate profits. But that bet is being placed against a devalued currency, setting the stage for one of the most high-stakes economic gambles in Japan's recent history. Speaking of high-stakes gambles affecting national economies, the situation in Washington is escalating. Now, Get this, the Trump administration is officially threatening to take sharp measures as a government shutdown drags on. A while back, we walked through that OMB memo quietly telling agencies to prepare for a reduction in force if talks failed. The latest development is that the threat has moved from bureaucratic contingency planning to an explicit political warning from the top. What really brought this to a head was the nature of the threat itself. In the past, shutdowns meant federal workers were furloughed, a temporary unpaid leave with an expectation of getting their jobs and back pay once politicians reached a deal. But what's being threatened now is something called a reduction in force, or RIF. A RIF isn't temporary. It means positions are permanently eliminated. This is a dramatic escalation because it turns a temporary political dispute into a permanent economic blow for thousands of families. The administration has now drawn a new line in the sand, signalling that this shutdown could result in thousands of federal employees being laid off entirely. And remember, in the last full shutdown, about 850,000 workers were furloughed without pay and ultimately got back pay. ARIF points to a very different outcome. This decision brings both a political advantage for the administration and comes with an inherent risk. It could trigger a severe and immediate shock to consumer confidence, especially in areas with many federal workers, like the Washington, D.C. region. If people believe they might lose their jobs for good, they will stop spending money immediately. And it's not just federal payrolls. Contractors historically haven't been guaranteed back pay, so the shock can spread even further. Believe it or not, this level of political brinkmanship can also infect financial markets. The latest saber rattling is exactly the kind of catalyst that wakes markets up. This perceived instability could lead to higher market volatility, pressure on the US dollar, and even make it more expensive for companies to borrow money. The core conflict is escalating. National Economic Council Director Kevin Hassett put the blame squarely on the opposition, warning on CNBC that Democrats will be responsible for any government worker that loses their job from this funding impasse. That's a shift from the technocratic tone of that earlier OMB memo to an overt political attribution of responsibility. Here's where it gets interesting. This kind of conflict creates a huge problem for the Federal Reserve. A prolonged shutdown with permanent layoffs would hurt employment and consumption data. But at the same time, the government agencies that measure this data, like the Bureau of Labour Statistics, would also be shut down. Past shutdowns have delayed key economic reports, and this would leave the Fed trying to make crucial decisions about interest rates completely in the dark. The drama is building as the Senate prepares to vote yet again on dueling Republican and Democratic proposals, both of which have already failed to break the deadlock that is now in its sixth day. Hassett confirmed that officials will be watching the next vote unfold from the Oval Office. His message was direct and leaves no room for interpretation. The threat of permanent job losses for federal workers marks a dramatic and unprecedented escalation in this high-stakes showdown. This willingness to use disruptive domestic tactics could also signal a similar hardline approach to international policy. For our audience in China, this is a critical signal to watch. An administration comfortable with this level of domestic disruption may be more likely to rapidly return to aggressive trade policies, such as using Section 301 of the Trade Act to impose broad-based tariffs. This could reignite trade tensions, disrupting global supply chains and creating new inflationary pressures. So, what should we watch for next? First, obviously, is the outcome of the Senate vote, but beyond that, keep an eye on market volatility indicators like the VIX. If it starts climbing, it means investors are getting nervous. Second, this sets a dangerous precedent. Normalizing sharp measures to win a budget fight risks a lasting dent to confidence in US economic governance, making investors question the risk of holding US debt in the future. The focal point is no longer just about a temporary shutdown. It's about the long-term credibility of US institutions. From a government threatening to cause economic disruption to one trying to fix it, let's head over to the UK. Let's start with a single statistic that might just change your entire perspective on this problem. Failed property deals are costing the UK economy an estimated £1.5 billion a year. In economics, this is called a deadweight loss, a massive waste of resources that benefits no one. A recent report from Santander breaks this down. About £560 million are direct out-of-pocket costs for buyers and sellers, like non-refundable legal and survey fees. But the bigger hit, nearly £950 million, is the damage to the wider economy from lost productivity and the sheer stress people face. This isn't just an abstract number. When people's confidence is shaken by such a broken system, it can make them hesitant to spend money elsewhere, which can be a drag on overall economic health. Now, the government has unveiled a major plan to overhaul the entire house buying system, aiming to cut that number in half. The proposal introduces a radical shift: legally binding contracts. This is designed to stop both buyers and sellers from walking away at the last minute, a practice that has plagued the market in England and Wales. The government estimates this reform could save first-time buyers an average of £710 and slash 4 weeks off the typical transaction time. This new system, which echoes practices in Scotland, would also legally require sellers to provide all key information up front. The goal is to stamp out gazumping, a tactic that has blindsided a third of all buyers over the last decade, but the plan is already facing major scrutiny. The Conservative shadow housing minister immediately fired back, warning this risks reinventing the last Labor government's failed home information packs, which was scrapped after being accused of discouraging sellers from even putting their homes on the market. When we place the goal of a faster market alongside the potential for fewer listings, the contradiction becomes clear. The total number of houses sold, what economists call transaction volume, is a vital sign for the economy. When housing transactions slow down, it's not just estate agents who feel it. It has a ripple effect, dampening consumer spending on everything from furniture and appliances to renovation services. The fear is that these new rules, even with good intentions, could choke off market activity. However, if you zoom out, you'll see another layer of complexity at play. Industry insiders are raising alarms about unintended consequences. Babak Ismail, CEO of home buying platform One Dome, stated that requiring more upfront information could actually delay properties from coming to market in the first place. His warning is stark. In a market where boosting supply is critical, any added friction must be carefully managed to avoid slowing things down. It all comes down to a basic economic principle. The number of new properties listed for sale is a leading indicator, meaning it helps predict future house prices. If these reforms make it more complicated or expensive for sellers, they might hesitate to list their homes. This would shrink the supply of available housing. With the same number of buyers chasing fewer homes, prices would inevitably be pushed even higher. This is the great paradox. A policy designed to help first-time buyers could end up making affordability even worse. The government is aiming for transparency and speed, but industry experts are now warning that the very same reforms designed to fix the market could end up adding critical friction, slowing down the supply of homes just when it's needed most. There's another angle to watch, especially for international observers and investors. By making transactions more certain, these reforms could, ironically, make UK property more attractive to foreign investors seeking stability. This could increase capital inflows. We know from recent data that foreign buyers are a huge force, contributing over £12 billion to the UK property market in 2025. For the Chinese market, a more predictable UK system could be seen as a plus. A surge in foreign capital could support prices in prime markets like London, but it could also widen the gap between investment-grade properties and the homes that average domestic buyers are trying to afford. The key indicators to watch in the coming months will be the monthly housing transaction volume reported by HMRC and the number of new listings on major property portals. These will be the first signs of whether this plan is fixing the market or accidentally breaking it.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.